Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global economics specialists, Giovanni Zanni and Kevin Cummins. Kevin, I'm going to start with you because I think it's really the US that's been driving global markets this week and we've got loads to digest, but let's start with the Fed. We're recording this on Thursday afternoon, so the Fed was yesterday. They delivered 75 basis points as was really widely expected. But what were your key takeaways from the meeting?
Yeah, I think I think the Fed and Powell in particular in the press conference really emphasized that they're fully committed and they want to see inflation come back down. So, for the time being, they're going to keep moving with rate hikes going forward. They want to see compelling evidence that inflation is moving down. And obviously, we know that, given the backdrop of the most recent inflation data, that doesn't seem to be the case just yet. So he's still talking pretty tough that ongoing increases are going to be the appropriate path. But I did, there was some uncertainty heading into the meeting whether or not he was going to speculate on the exact size of the next FOMC meeting, similarly to what he did in June and July. And obviously, the delivery ahead of the June meeting was a little clunky. So, there was some uncertainty going into yesterday. But he delivered with the 75 basis points that everyone generally expected. But he wasn't willing to necessarily go on the hook as of today, which makes perfect sense given that they're at their neutral level. So, the path going forward, the hurdle is probably a bit higher than it has been to be so aggressive. But, from the perspective of, it's certainly a possibility that they'll go again in a supersized 75 basis point rate hike in September. But it'll come down to the data. That was his main message, is that going forward, it's really going to be a meeting-to-meeting approach and very much data dependent.
So how does that leave you then? I suppose there's a lot of different variables between now and the next meeting and definitely between the meetings ahead. And one of those variables we will talk about in a second, as we've just had that today. But how does that leave your rates forecast for the next couple of meetings? Is that changed after yesterday, or have you left that unaltered?
No, we've left it unaltered. When in the press conference, he did say that the June dot plot is probably, sometimes it does get old pretty quickly. And he made it a point to say that, if they had to release new dots, it's paraphrasing what he said, but for the most part, that still seems like a reasonable path. That he did emphasize that, as I mentioned, that, the ongoing increases are going to be appropriate. So the message was that rates are still going to move higher. Given our expectation over the next couple of months for inflation, we do see a little bit of moderation in the next two reports on the CPI. So I think that will allow them to dial it back a little bit. If there is a surprise to the upside there, then maybe they'll go again with this other, supersized 75 basis point hike. But our expectation is that they will dial it back down to 50 in September. And kind of given the moderation that we expect, while it's still an elevated level later this year, we do think that they probably will get it down to more moderate, typical rate hikes of just 25 basis points, both at the November and the December meeting and the first quarter of next year.
And I suppose you feel a little bit validated in that view then by the data that we've had today. So as I mentioned, we're recording this on Thursday afternoon UK time. So we've obviously just had the Q2 GDP release, which came quite significantly weaker than expectations. What's your take on that? What were kind of the drivers of the weakness, and how does that feed into the Fed's thinking, I suppose, for the next couple of months?
Yeah, for the time being, I don't think it probably changes their game plan. Certainly not for this year. We'll have to see how the data evolve. But I think, the Fed wants to get into restrictive territory, and it depends on how high. He made it pretty clear that he wants to go into moderately restrictive territory, which would be consistent with what they published back in June in the dot plot. You know, anything is obviously possible, but I think what he really emphasized was that he wants to see slack. Now, growth may contract even further in coming quarters. There's certainly a possibility, but you know what, he said he didn't have this data, but the Fed obviously has a whole slew of economists that are looking at these numbers on a regular basis, so they knew it was going to be weak whether or not, you know, he saw the headline print. He mentioned that business investment contracted in the second quarter, so he did suggest that he had a pretty good handle on this morning's report, even though the markets were, you know, looking for a little bit of a positive number, and it came in below expectations, a contraction of almost 1%. So I think the backdrop probably for the Fed hasn't changed overnight, but you know, if growth is slipping into a recession later this year, then you know, you could make the case that next year, instead of going, you know, very restrictive, they perhaps go something in line with what they had in June. But you know, it'll be a meeting to meeting approach. But I think the message will continue to be, you know, they would like to see positive growth, but it's not a necessary condition for them, that it's going to get in the way of them continuing to raise rates, just given the inflation backdrop. I mean, in our own forecast, we have inflation hanging around about 4.5% through the first half of next year, core inflation. So, you know, that's well above their 2% target. We end 23 still above their 2% at 3%. So, you know, that sort of backdrop, even though if you're assuming that growth is going to slow and potentially go into recession, you know, that inflation eventually will slow. But I think that's the Fed's goal here, is to introduce slack in the labor market and add to their potential view that inflation is going to moderate down towards 2%. And a recession certainly would aid in that and give them some confidence that the worst probably is over.
So how do you kind of square that, I suppose, then with market pricing that they're going to cut pretty quickly as we head into 2023? Is that wrong at this stage, do you think? Will they be happy just kind of leaving rates where they are, or what's your...
I don't think the Fed is going to be so quick this time around, because inflation's been so high and it's likely to linger. Now, inflation is a lagging indicator, and I think that if you do, as I said, get a recession, that eventually inflation will come down. But unlike earlier easing cycles, you know, we didn't have this sort of inflation that the Fed could, you know, be there for the rescue. And certainly they've moved up to a more neutral stance that allows them some firepower. But, you know, with the backdrop of inflation being as high as we expect, it's going to be a lot more challenging for them this time around. So I think, you know, they probably will remain on the sideline after they get into some restrictive territory. Now, you know, we still have a ways to go to get into 23, but I wouldn't think that you're going to see much action next year, even though the market expects, you know, a quick, you know, if we do get back-to-back quarters of negative growth or something like that, outside of what happened in the first quarter, because I don't, you know, Powell very much made it very clear, as most economists here don't believe that first quarter contraction that is reported. And in September, we'll get the annual revision to GDP. Typically, it comes in the second quarter. This time around, I wouldn't necessarily be all that surprised if we no longer see a negative in that first quarter. We'll see. But, you know, it's very clear that the economy is slowing, and the tightening in financial conditions, this is what the Fed wants. The Fed wants to avoid a recession, sure, but they definitely want to slow the economy, introduce some slack into the labor market, given how tight it's been. And, you know, they're more concerned, their top priority is to fight inflation. You know, they'd like to see growth remain positive, but I don't think that is necessarily going to get them to stop hiking and to start cutting rates.
Yeah, that makes sense.
Yeah. So now, with the Fed out of the way until September, I guess we can look forward to the BOE next week, and you know, round out the weeks of central bank meetings here. So maybe, Imogen, if I guess the major question for next week, if I could ask you, is either 25 or 50, and just wondering where you sit on that debate.
Yeah, it feels like I've been posing that question to Jan for the last couple of weeks about 75 or 100. So I suppose it's only fair that I have to answer the same thing when it comes to the Bank of England. We're very firmly on the 25 basis point side. It feels like, well, up until today at least, and well, perhaps yesterday with a slightly, more dovish Fed perhaps than markets were looking for. It feels like consensus was shifting quite heavily into the 50 basis point direction, and that's obviously where market pricing was and still is quite strongly in that direction. But actually, and I've repeated this on the pod before, but the change in the language that we had in the last meeting around acting more forcefully if they see signs of more persistent inflation was very conditional on this idea of seeing signs of persistent inflation. And Bailey and Pill have both been quite clear that high inflation today is not the same as persistent inflation. And the data that we've had over the last 6 weeks haven't really been reflective of this idea that there is persistent inflation. We had GDP that surprised to the upside, but we all know now that that was just a kind of bank holiday distortion effect. And to the extent that GDP was higher than expected in May, it's likely to be lower than expected in June. We had headline CPI that slightly surprised to the upside, but core inflation that moderated for the second month in a row. And although headline inflation was slightly above where the market was, actually it was very much bang in line with the Bank of England's Q2 forecast. And the labour market data was mixed, but really if we're looking for signs of persistent inflation, then the headline average weekly earnings number was weaker than expected as well. So I just don't see evidence of enough strength in the data that would warrant a 50 basis point hike, that given that they haven't yet hiked 50 basis points in this cycle. And to the extent that, markets interpreted this idea that the ECB did 50 basis points as a green light for the Bank of England doing 50, then, the fact that the Fed was weaker and now we've had significantly weaker GDP today out of the US than expected, I do think that should take out some of the kind of heat in terms of Bank of England pricing. The only thing that has pointed to, I suppose, more persistent price pressures is this decision maker panel survey, but really that just reflects spot inflation, and the idea that the Bank of England would want to change course in terms of monetary policy and hike significantly faster, justified purely by that survey, seems a bit nonsensical. So we're firmly on the 25 basis point side of the debate, but I recognize that we're in a shrinking minority, I think.
Got it. Yeah. Well, unlike the ECB and the Fed, this is one of the BOE's quarterly meetings with updated projections and a press conference. So is there anything else you're watching out for?
Yeah, I guess actually in some ways, although we're very focused on the 25 versus 50 debate, it's probably more important than that. I think it's less about what the Bank of England do next week and much more about what they signal in terms of what further tightening is required, because whether they do 25 or 50, we will then be at the rate that they've been signaling for a long time is what they consider to be neutral or the kind of terminal rate in this cycle. And so we'll be watching the forecast pretty closely. I think on the growth side, they probably don't change them that much, just given that they were pretty pessimistic back in May. But on the inflation side, we probably see upward revisions in the near term, largely driven by the kind of increase in the off-gen price cap that's due in October. But over the longer term, using the market pricing, I think that the change in the exchange rate is probably more than offset versus what the market has now priced in additionally in terms of bank rate pricing. And that probably means that you get a lower inflation forecast at the 3-year point than we previously had in May. But like I say, we'll be closely watching what they kind of signal in terms of what this means for terminal rate and where that needs to get to. They probably raised that slightly, and that they signal that there's still some additional tightening still required after this hike next week. But we think more like 2% versus the kind of 1.5% that they have right now, which is still significantly lower than the market is pricing. The market has 150 basis points of tightening priced in by the end of this year, which would take them to much higher than 2%.
Got it. Okay. So where does that leave you on market views then?
So I guess the front end view falls out pretty obviously from that. We think that the chances of a 50 basis point hike next week, although they're not zero, are still quite low. So the fact that the market has this, well, it's pretty volatile at the moment, but the fact that the market has that kind of 90% priced in seems wrong. I can see that they may well hike 50 basis points next week. Like I say, it's not a 0% chance, but the idea that they do 150 basis points, even if they do 50 basis points next week, 150 basis points by the end of the year just seems completely at odds with the kind of deteriorating macro backdrop and their guidance, which for all their criticisms has been pretty consistent so far. So the front end view is quite obvious, either receiving kind of very near-term MPC dated SONIA, or even just out to the end of the year, kind of December MPC dates. The longer end of the curve, I think, is much more driven by QT and the fiscal side of the story. And that's the other thing I probably should have mentioned in answer to the last question about what else we'll be looking out for, because the August meeting is the moment where they have committed to kind of reporting back on QT. Bailey gave us a little bit of an idea of what QT might look like last week, and we discussed that in last week's pod, so I won't kind of rehash that. But in terms of what they announced next week, I think that actually they're a little bit more granular on the detail than we were previously expecting. We expect the pace to be 35 billion, starting as early as October perhaps, so they maybe announce some of the high level details next week and come back and vote on that at the September meeting, ready for sales in October. And I think that they broadly conduct this across the curve, and therefore, to the extent that they do enough kind of active sales to matter for the market, I think that it matters more for the long end than for the front end. And when you add on the impact of QT to what we already see in terms of fiscal slippage, the political backdrop, which adds even further risks of kind of higher and earlier fiscal stimulus, I think that adds up to higher yields at the long end of the curve. That said, of course, we see this quite significant repricing at the front end and these recessionary risks now weighing, which keep a lid on how much higher yields can go. But I do think that this idea that QT is coinciding with a time where we're likely to see significantly higher gilt issuance as well can't be ignored for the long end. Anyway, I'm sure we can discuss all of that when we have more detail next week. So let's flip over to the Euro area, where there's been a lot going on there this week as well. Gio, we've got you. So let's start with Italian politics. I think we probably briefly spoke about this last week, but since we've spoken about it, we now have a date set for Italian elections, so the 25th of September. Feels like a long time away, and I know a lot can change between now and then, but as of today, what would you say is your base case outcome for those elections? And well, I guess it's kind of a three-pronged question. What's your base case outcome? What will you be watching closely to kind of that might make you change your mind on that? And how do you expect markets to react in that base case scenario?
I mean, I think the first question that we have to understand is who's going to fight in this electoral campaign, because on one side we have a defined coalition. On the right side we have the nationalists from Fratelli d'Italia, we have the Lega, Salvini's Lega, and we have Berlusconi's party, Forza Italia. But on the left side it's still undefined, because the idea that we would have had a coalition between the Democratic Party and Movement 5 Star is not really there anymore, given that Movement 5 Star was the reason behind the initial sparkle that triggered the fall of Draghi. So the Democratic Party doesn't want to do that coalition anymore. So the question is, what will happen there? There are a lot of centrist parties, there are left parties, small parties. So the definition of that is really the first question. And there is a deadline, 21st, 22nd of August, when you have to officially present your lists, and everything can really still happen between now and then. Also because within parties things are moving. Some Big names in Berlusconi's parties are leaving to go to join the centrists. In the movement 5 Star, there's a lot of ferment as well. Some people have left, others are leaving too. So it's still quite undefined. And I think that this is really the thing to follow in the next few days and weeks. So I would say it's very complicated. You were asking about what you expect in terms of results. Well, as of now, if you look at the polls, if you look at the electoral system in Italy, there's a strong chance that the center-right coalition will have a very large majority, up to 2/3 of MPs. So that's the starting point. Then things can change from here. You asked about BTPs. As we all know, there has been already some slippage in the spread, but it has been contained also because if you look at the fiscal numbers, if you look at the issuance needs of Italy, if you look at also the fact that you have anyway this announcement of the TPI from the ECB and reinvestments, pepper investment, you have a lot of things that can calm things down for now. And also I would say that if you remember the 2018 political episode, what happened after the elections, when the Lega and the Movement 5 Star put together government, strongly anti-European, and this was a trigger. I'm not sure you have the same set of variables, factors right now. You have the incentives to receive EU funds, the EU recovery funds, and the situation in terms of anti-European sentiment is different from 2018. I think that Brexit as well is not a supporting example for nationalists. So the setting is a bit different, but that's still the risk there.
The other thing that I guess has put pressure on BTP spreads this week is the downgrade by S&P of the outlook from positive to stable. How worried are you about that being the beginning of a trend, I suppose, and taking us back to this 2018 period where, we were worried that Italy would be downgraded to junk and the ramifications that would have about demand for BTPs and particularly, I suppose, as eligibility criteria for the ECB too. Is this the beginning of a trend, or is this really just a lagging indicator that you're not overly concerned about?
Okay, so S&P turned positive when Draghi was nominated, and then they removed the positive immediately after he left. So it's a very specific event, and actually S&P is now back to where all the other rating agencies are. So it's not a big innovation in a sense. I'm generally less bearish on the debt sustainability criteria for Italy. I think that there's a lot of things that people don't really look at: private debt, external position. Italy is quite solid, I think, from a macro perspective, more than most people think. Having said that, Draghi was the best possible MP, Prime Minister, PM for Italy and to reassure investors. So that's clearly a credit negative. Then if you ask me if I think that there is an independent risk for Italy related to the ratings and to the investment grade, etc., frankly, I don't think so. I think we're going back to the political risk. If the new government after September will be compliant with European guidelines or clearly strong in opposition, anti-European, and I'm not just talking about economics, about policy, I'm also talking about geopolitics, because that's another concerning issue. So in that case, the risk for spread is going to increase. I mean, that's really what matters. So that will be what we need to check. And it's a little bit like what happened in 2018. So that's really the risk. My point, in any case, will be that you don't leave the euro, the euros leave you, in the sense that as soon as you have this kind of situation, there will be an immediate financial crisis, and that should prevent things continue in that direction and a return to normality after a crisis, of course.
Away from Italy then, but I suppose very much so relevant for spreads. And just to round out the discussion today, we also had German inflation, and I guess it got a little bit lost in all the excitement or non-excitement of US GDP. But we've had a flurry of the kind of regional prints last night and this morning, and they all surprised to the on net surprise to the upside. What do you make of that, and how much does that matter, I suppose, for the ECB, for the growth outlook, for the inflation outlook from here?
Yeah, so it's very difficult for the ECB because, again, upside surprise, 0.4 percentage point on Germany mathematically is another 0.1 plus for the European number. And actually the forecast for the European number from, the consensus at 8.7 after 8.6 in June, for me was already on the low side. I had 8.8. Now, if I had to put a number, it would be 8.9 or even 9% for tomorrow. And so again, we have a higher print for the ECB, which is not good. But at the same time, it's food, because of energy, it's gas, utility prices. It's all the same thing. So if you look at core inflation, it hasn't really moved again. So it's a very difficult situation, and you have all the other indicators, macro indicators, so all the growth indicators, but also inflation expectations that are turning. So the reality is that we will get still higher inflation prints in the coming months. We could even get close to 10% if we still get this crazy, gas prices again where they are stabilized or even getting higher. Who knows? But the reality is that at some point this should end somehow, and so the fall from this very high level could be even larger. So you will have very huge base effects by the end of next year. So I would say inflation going below 2% in terms of headline is quite likely by the end of 2023. So as it happened in 2008, as it happened in 2011. So this is the kind of dynamics that we've seen in the past. So it's very difficult for the ECB to conduct monetary policy in that situation. We already had errors, Trichet in 2008 and 2011. Again, so a similar mistake is quite likely. Maybe the underlying situation is a bit different. We're starting from much lower interest rates. So I think that some normalization is anyway needed. And if you look at our forecast, we're not really fighting this idea of getting to some kind of neutral numbers by mid-2023. So, again, this is the situation, very complicated. I think that the ECB has all the right to be, deciding meeting by meeting, and this is the situation, and we cannot change that. So,
yeah, I guess that's the new central bank theme, really, isn't it? Data dependent, meeting by meeting. But for markets, it just seems to be, more volatility, more risk premium. Every data print in every country becomes more important. Every speech we pay so much more attention to, because that is now our forward guidance. All right then, guys, thank you both so much for joining me today. It was a super relevant week to have our economists on, so I'm very grateful to have you both, and thank you to our listeners for listening as well. And just a reminder that if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episode as soon as they're available. Thanks, see you next week.